Hello, scholars. Today we are going to talk about Chapter 11, Current Liabilities and Payroll. If you remember your balance sheet equation, asset is equal to liabilities plus equity. Under liabilities, we have a short-term or current liabilities, and we also have long-term liabilities. So in this chapter, we are going to study only the current liabilities and as well as payroll. Payroll is also a current liability, but why did they use the word separately? We'll talk about later in the chapter. As you already know that the definition of a liability is it's a debt that you owe to your creditors. Means you have borrowed something, borrowed money, you have borrowed uh, an equipment, or you have borrowed someone's services, or you have borrowed money and you have to pay back at a later time, or you have to pay the rent. For example, if you borrow the money, you will have to pay the rent in the name of interest. And if you have borrowed a vehicle, for example, so you have to pay the rental for that vehicle. And if you have hired somebody, you have to pay the salary, which falls under payroll. So liabilities are obligations resulting from past transactions or event that required a company to pay money or provide goods or services in the future. So what we are talking about obligation. So you are now obligated to pay someone or pay for something because you either use the services or their product, and that's why you have to pay them, and that's why you owe them this money. And that's why when you owe somebody, it's a debt for you, that all the debts should be paid. Liabilities have three main characteristics. They occur as a result of past transaction or event. Means you hired somebody last month, they worked for you for 3 weeks, and now you owe them a 3 weeks worth of salary. They create a present obligation for future payment of cash or services. So you have received the money in advance, and then you will have to pay in the future cash. For example, you borrow the $10,000 and you have to pay the interest in the future, and the interest payments are always cash payments. Services simply means the customer has given you the money in advance. Say for example, you go to the bakery and you give them $100 and say that please deliver a cake in a couple of weeks, and then they will deliver the cake. Until they deliver the cake, you have what we called an obligation to provide them a cake in 2 weeks. Current liabilities must be either with cash or with goods and services within 1 year or within the entity operating cycle. Usually it's always is a 1 year deal, that if you borrow something on a short-term basis, or if you have received a service, then you have to pay within a year or an operating cycle. Long-term liabilities that we will discover in the next chapter do not need to be paid within 1 year, because the life of a long-term liability is greater than 1 year. And we're going to talk about three long-term liabilities in the next chapter. So the examples of current liabilities are accounts payable, sales tax payable, and unearned revenue. In fact, anything that's end up as a payable, for example, rent, utilities, interest, anything that falls with the word payable, it's usually a liability, and the life of it will tell you whether it's a short-term liability or long-term liability. Our current liabilities always have a life less than 1 year. Okay. Long-term liabilities that we're going to talk about: notes payable, mortgage payable, bonds payable, and there is something called leases we're going to touch a little bit. Notes payable, it's slightly the word that we use is used both here for the current liabilities as well as for the long-term liabilities. If a life of a note payable is greater than 1 year, it would be considered a long-term notes payable. And if a life of note payable is less than 1 year, then it would be considered a short-term note payable. All right. So we have to keep that in mind because there will be questions in your homework exam and quizzes. They talked about long term as well as short term. It's not going to happen in chapter 11 and 12, but it's definitely going to happen in the final exam when you will see questions from every chapter. And also exam 3, you will also have questions from both chapter 11 and 12. So you have notes payable, and some of the questions sometimes do not clearly say whether it's a short-term notes payable or long-term notes payable. So I want you to carefully read the questions to decipher whether it's we are talking about a short-term notes payable or a long-term notes payable. Now we're going to talk about a very important liability. It's called sales tax liability. So as you know, we are living in a state of taxes, and in the state of taxes, every time we go for almost every transaction, with the exception of few, we have to pay a sales tax on it. And when we are purchasing, we have to pay the business the price of the product or the services that we are getting, and plus the sales tax. The sales tax is collected by the vendor or the merchandiser, the company or the business or the person who is selling the service or the product. They collect that sales tax on behalf of the state of taxes. So for example, if a business has collected $1,000 worth of sales tax on behalf of a state of taxes, they cannot keep that sales tax to themselves. They have to transfer that sales tax to the state of taxes. So for some businesses, they are required to transfer the sales tax within 15 days. Some businesses are required to do in 30 days. Some businesses are required to do in 45 days, and some businesses are required to do in 45 days or 60 days, depending upon the workout the deal with the state of taxes. So a sales tax is not an expense of a business. You basically taking the money, keeping the money under the account of sales tax, and you transferring the whole amount back to the state of taxes. And it's a current liability. Like I said, you can keep this money in your business only for up to 15, 30, 45, or 60 days. And companies collect sales tax and then follow the state at a regular interval. So for example, if I am purchasing for example, it's something for $100 and I'm paying $100, $108.25. So that $100 represents the revenue for the company for selling the product, and $8.25 represents the sales tax they have collected on behalf of but the total cash they have collected is, so for example, they will debit the total cash is $108.25, but when they're going to credit, it's a sales revenue for $100, and they're going to credit sales tax for $8.25. So this is how they do that. Unearned revenue is another important questions you will see in this chapter, and we have discussed this in chapter 1, 2, and 3 and 4, and then we're going to revisit again. And unearned revenue is when a business received the cash before giving the money. So when you receive the cash, you're going to say debit cash for $100 for whatever you are providing, and you're going to credit unearned revenue for $100. So, and once you provide the service, you will debit the unearned revenue, and then you credit the what we call the salesperson. So here we have given an example for you. Include tickets sold in advance for an event or down payment on merchandise because the revenue has not been earned yet and is treated as a liability until earned. Assume Southwest Airlines sells a ticket on June 1 for a travel on July 15 for $300. So on June 1, the Southwest Airlines receiving $300 cash, so they are debiting cash for $300, but you haven't fly yet, so they will credit unearned revenue for $300. But on July 15, as soon as you take a flight, that unearned revenue is gone and it's converted into a sales or ticket revenue of $300. So this is the day they're going to recognize the revenue, and that revenue will translate or transfer to the income statement. All right, on that day they are recognized this sale as a liability, and it will stay in the balance sheet until the date July 15. So for the next 45 days, you are recognize this as a liability, and it stays in the balance sheet under the current liability section. And once the customer use the ticket, it becomes their revenue and move from balance sheet to an income statement. Okay. Now in this, they are talking about short-term notes payable. When they are telling you short-term notes payable, that almost always means life is less than 1 year, because short-term is always means less than 12 months or a year. Represent a written promise by a business to pay a debt, usually involving interest within 1 year or less. So not notes payable is usually means that you are borrowing money. So business occasionally borrow cash from banks for 3 months, 6 months, 9 months, 7 months, 8 months, whatever that might be the case. A bank requires a business to sign a promissory note. A promissory note or a notes payable is the same thing. There is no difference in it. The business will pay the principal, the amount they are borrowing, plus the interest at whatever date they have negotiated. For example, today is October 1st, and they're borrowing the money. So the business is going to make this journal entry: debit cash $10,000 and credit short-term notes payable of $10,000. And they will make a little note here: borrowing for 6 months at 7% interest. So they make a note here in the system that they have borrowed $10,000 cash from the bank, and they sign a note for $10,000, and the note is borrowing for 6 months at 7% interest. Why is it important? Because it helps them calculate the interest. So you will calculate the interest 6 months later. So October 1st you are borrowing. So October, November, December, January, February, and March. So so what you're going to do so the entire month of October, the entire month of November, entire month of December, entire month of January, entire month of February, and entire month of March. So that on March 31st you will have to pay this the short-term notes payable. So what you're going to do is you're going to credit cash. So how much cash you have to pay? You have to pay the $10,000 you borrow, and you have to pay the interest. So how do you calculate the interest? You calculate the interest by $10,000 multiplied by 7%, 7 over 100, into 6 over 12, because you borrowed for 6 months. So this cancels, and this cancels $50, and that's $350. So $350 is your interest. So you're going to pay $10,350, and you're going to debit short-term notes payable for $10,000, and you're going to debit interest expense for $350. That's how you do that. Now we're going to talk about current portion of long-term notes payable. So long-term notes payable is typically reported in long-term liability section of the balance sheet when the long-term debt is paid in installments. What does it mean by installments? Is means that you borrowed $100,000 or let's say $1,000,000, but the bank is requiring you to pay every year at the end of the year $100,000 plus the interest. So what you are paying in installments. So every year $100,000 becomes your current liability that you have to pay the $100,000 plus the interest. So suppose you borrow $1,000,000 at a 10% interest, that means first year interest will be 10% of $1,000,000 would be $100,000. So you're paying $100,000 for the interest and $100,000 first payment. Now, once you make the installment payment, you now owe them only $900,000. So next year you will be paying interest only on $900,000. So that means your interest will be less. You're paying interest $90,000 plus $100,000 payment of the interest. So that's and we will work on a. I have worked on a problem and I already posted it. You can look at it. Examples: interest payable. Panuma Corporation signed a 90-day note on November 1 for $10,000 with 6% annual interest in exchange for equipment. So what we are getting, they are getting equipment for $10,000, but instead of giving them the cash, they are giving them a notes payable of $10,000, and they are borrowing at a 6% annual interest. So the interest expense will be how much? $10,000 multiplied by 6% multiplied by 2 over 12. Why 2 over 12? So that's important. You are on November 1st. From November 1st to the end of year is December 31st. So here is November 1 and here is December 1. So you have this 1 month and here is 2 months. So on December 31st, you are calculating. Why are you calculating this? December 31st is end of year. And end of year, you have to publish your financial statement. In that financial statement, you have to tell everything. And why we are doing for the 2 months, you remember in the first 4 chapters, we talk about a concept of matching principle. Matching principle simply means that we have to match the expenses with the revenue that we have earned during the period, so we know how much revenue we have earned and how much expense we have. So we are purchasing this equipment for $10,000. We don't have the cash, so we are borrowing the money with a $10,000 notes payable, but we have to pay on this notes payable interest. And this interest belongs to these 2 months or belongs to this year. So therefore, we're going to calculate the 2-month interest, which turns out to be $100. And that $100 expense will be part of this year. And the rest of the interest we're going to pay until we paid off this $10,000 will be part of the next year. So therefore, this interest belongs to this year. To record the payment of note and interest, debit interest expense is $50 and debit interest payable for $100, debit notes payable for $10,000. Now you must be wondering where this $50 and where this $100 comes from. So let's do this way. So $10,000 multiplied by 6 over 100 multiplied by 2 over 12. So this one is gone, this one is gone, and these two are gone. So we left with $100. So this $100 is the first 2 months. And now they have borrowed for 3 months. So 60 days has already been gone. So now we left with 30 days. So the 30-day interest from January 1st to January 31st would be how much? $10,000, 6 over 100 and 1 over 12. Right? So 100 divided by 2 is $50. So this $100 belongs to November and December. This $50 belong to January. So since you have to record this one, so what did you say on December 31st? Debit interest expense for these 2 months $100 and credit interest payable for $100. What you are saying by entering this information, we do owe this bank or this Panama Corporation $100 because we owe them $10,000 that we promised to pay them on January 31st, and that's why we owe them $100. But when January 31st comes, you have another $50 of interest expense for this month, and a previous interest payable from the last 2 months, and a notes payable of $10,000. So you debit the interest payable, means you don't owe them anything, and you are debiting the notes payable that you now, after making this payment of $10,150, you do not owe them this, you do not owe them this, but this $100, and so this $50 and this $100 will be an expense for your income statement. So your income statement will show, when we borrow this $10,000, it cost us $150 in interest, the $100 from the previous years and the $50 for this month. So these basically are your current liability. We're going to talk about a little bit more in a minute. So let's first talk about payroll. Payroll are also called employee compensation. So for example, if you are working somewhere right now, you are getting hourly wage or a salary. That is your compensation for the services that you are providing to your employer. But as a worker, you know that you do not get your paycheck before you work. So you have to wait in order to get your paycheck. So for example, you start working on Monday. You're not gonna get your paycheck on, most likely on Friday. It may takes about 2 or maybe 3 weeks before you get your paycheck. So your company owes you, the business you work for owes you for this amount of money. So for example, first Monday, you work 8 hours, you make $15 an hour. So that means on that day you make $120. You work Monday through Friday, every day your salary is accumulating as an expense for the employee, $120. And the first week you make about $600. You work for second week, and then you accumulate another $600 by working 40 hours. In the third week, you work for another 40 hours and accumulate another $600, but you will get paid for in the third week for the first week and the second week. And most people get 2-week paycheck bi-weekly. So for that, $1,200. So that $1,200 represent your gross salary for $15, based on $15 an hour, provided you didn't work any overtime. And then from that $1,200, as you know, you have to pay federal tax, and then you have to pay FICA, which is your Social Security and Medicare. So these are the basic taxes that everybody has to pay if living in the state of Texas. For example, if you're living in New York, then you have to pay federal tax, you have to pay the state tax, and you have to pay a city tax. I mean, the federal state tax is less than the federal tax, and the city tax is less than the estate tax. However, the FICA or Medicare and Social Security would be same throughout the United States. So for service organization, payroll is the major expense, is one thing that you can remember. They have numerous ways to label employees' pay. It's a salary, compensation, commission, bonus, and benefits. So salary include the compensation or hourly work. Commission is usually most of for the people who work on job provides their salary on an hourly basis, plus they also receive commission for various reasons. Most likely is a sales commission. Bonus is could be a performance bonus that you can receive either on a quarterly basis, 6-monthly basis, or a yearly basis. Benefits, it could be sick leave, paid vacation, your company is paying for your gym fees, or your company is paying for your insurance. All of these are part of the benefit, and then we'll talk about more how we calculate. So what are payroll related liabilities? Payroll expense are a major cost for most firms. Salaries and wages. Wages are always hourly, and salaries are on a monthly basis. For example, I work for my college. I get a monthly salary, but a lot of student workers who work part-time for the college, they usually get hourly payments, $10, $15, whatever their hourly rate is. Amounts withheld from employees' paycheck by employers. What are the amounts withheld? I talked about federal tax withholding, FICA. These are the two important ones that the businesses, whether you work for government, non-profit, or for-profit, they withheld this amount. And basically, federal income tax withholding, it goes to IRS, and FICA basically go to Social Security Administration. So just like the business transfer the sales tax to the state of taxes, the same way whatever federal income tax withholding that the employer deduct from an employee paycheck goes to IRS, and the FICA payments goes to Social Security. Payroll taxes and benefits paid by the employer, also part of the liabilities. We're going to talk about in a minute. Amounts withheld from employees' paychecks are federal, state. I mean, in Texas, we do not have the state tax. I think there are only 5 states in the United States that do not have a state tax. One is Texas, one is Florida, one is Alaska, and there are 2 more that I cannot recall, but the 3 states, they don't have any state tax. But Social Security and Medicare taxes comes from everyone's paycheck. There are other amounts. It could be health insurance, union dues, and retirement, such as 401k or 401k plan. For example, you contribute in your 401k plan. If you are part of a union, you pay your union dues. Health insurance. Some companies or firms pay entire 100% of your health insurance for the employee, and some pay a partial 50-50 or 60-40, something like that. Payroll taxes paid by the employer are FICA, federal, and state unemployment taxes. State unemployment tax, something that your employer pay in the state of Texas, and if you get unemployed and you get some kind of a money from there is a office, I can't recall it the very moment, they give you a amount of money if you are laid off and while you're looking for a second job. So what is a gross pay and net take home? 2 pay amounts are important. So gross pay is what you are paying, like $15 an hour or $50,000 a year, minus federal income tax withholding, minus FICA, minus a couple of other things, and then you will get net pay. And the reason I'm only showing these 2 is because these 2 are the most common withholdings to calculate the net pay. So net pay is also called the take home. So let me give you a rough. So you work $15 an hour and you work 40 hours a week. So your gross pay is going to be like $1,200. Say your federal income tax is $150 and your FICA is $75. So that means after subtracting $225 from this, so you take home salary will be $907. This is just a rough calculation. Different people have different calculation based on a form that people usually follow, is called W4. The way you fill out your W4, it describes how your taxes will be deducted from your paycheck. And this is just for your knowledge. It is not part of your exam or quiz or homework. So gross pay is the total amount of salary, wages, commission, and bonuses earned by an employer. Net pay is the amount employee gets to keep. Net pay is also called take-home pay. Required deductions are, like I said, federal and state income taxes. So in Texas, you do not have a state income tax, so you only pay federal. Everybody pays Social Security tax, which is also called FICA. Other deduction required by federal, state, or local. So I gave you an example of New York State, and they have optional is insurance premium if you signed up for retirement contributions such as 401k, and charitable contribution if you want to make a charitable contribution. Say you want to pay $50 from every paycheck to American Heart Association, so they will deduct $50 every month from your paycheck after these deductions. So you are paying this. Withholding the employee income tax. The income tax deducted from gross pay is called income tax withholding. The amount withheld depends on employee gross pay and the number of withholding allowances claimed, which again, you claim all of those things in a form called W-4. Okay. We're not going to talk about probably in this class what a W-4 is, but if you ever work for some companies, they will ask you to fill out that form. An unmarried taxpayer usually claim one allowance. A childless married couple usually claim two allowances. A married couple with one child usually claim three allowances. So you know that how many dependents you have. So if there is a family of four and a husband is going to claim four, one for himself, one for his wife, and two for his children. Withholding and for employee social security tax. The Federal Insurance Contribution Act, FICA, also known as Social Security Act, is created the social security tax. So this was done in the century ago almost. The letter requires employee to withhold social security tax from employees' paycheck. FICA has two components: OASDI, old age, survivor and disability insurance, and Medicare benefits, medical benefits that you start taking either if you become permanently disabled or if you reach a certain age. I think for majority of us is the age of 65. So that means at the age of 65 you don't have to purchase insurance. You will be enrolled in the Medicare program. Some companies withhold payroll deduction and they pay designated organization according to employee instruction. It could be insurance premium to your health insurance, retirement savings for your 401k, union dues, gifts to charities, and optional withholding deductions. That could be for other things. Employer payroll taxes. Employer must pay at least 3 payroll. So this is for employee and this is for employer. So I hope you keep a difference here, employee and employer. So there are two different kinds. One is paid by the employee individually and one is paid by employer. 3 taxes. These taxes are not withheld from employees' gross, but instead are paid by the employer. So for example, you paying $75 for FICA, that means the employer also paying $75 for you. And unemployment compensation taxes, SUTA for state and FUTA for federal, is also paid by employer. So these are employer taxes that employer pay. You don't have to worry about as an employee. Now we're going to talk about internal control over these things. There are two main internal controls for payroll: controls for efficiency, and payroll is usually automated rather than prepared by hand. Majority of the companies usually outsource their payroll. Outsource payroll. There is a very famous company, I cannot recall the name. This company basically does payroll for a lot of companies. And these days, you do not receive a check in majority of the places. It usually goes directly into your bank account. So for this reason, companies do not keep a payroll department in their in-house and they outsources. Controls to safeguard payroll disbursement: employees sign for checks or present ID. So for example, if you are a small business, you most likely know all your employees, and it is a good control. So every time employee wants to pick up their checks, if you are giving them a manual check, they should present an ID and they should get a check. I mean, it is a good idea that owner distributes a check for each employee, but you can do it when you have, like, say 10, 15, 20 employees, but you have 100 employees. Owner may be more busier and they may designate a person who keeps all the 100 checks, and everybody who needs that check will go to that person in a particular office, show the ID and get the check. hiring and firing are separated from payroll preparation, means and the hiring and firing should be done by HR department, and HR department could be an in-house department or it could also be an outsourced department, but that should be two separate departments. And payroll needs to get from HR every pay period an updated list 2 days, I believe in majority of the cases, 2 days before the payroll is due, that they want to know in case if you have hired or fired anybody from the job. It is very important to do that. Time clocks and direct deposits are also used. Time clocks, basically you go to work and you punch your card or enter your ID or social security number to let the business know that you are here and you are working on your assigned job. And direct deposit is also helps, manual paychecks sometimes get lost in the mail or in the distribution, so that's why it is important to keep that way. Now, estimated current liabilities. How do you estimate? A business may know that a liability exists but not know the exact amount. It must estimate the amount of the liability and report it on the balance sheet. It usually happens on end of the year. So for example, you receive your last paycheck on December 26, which is Friday, right? But you also have worked, so you receive the paycheck on Friday, December 26. Now you have December 27, December 28, December 29, December 30, and December 31st. Now, this belongs to 1 year. On December 31st, you are closing. So for example, you have worked 8 hours on these 5 days, right? But you're not going to get paid because you have already get your last paycheck on Friday, December 26th. So you got your last paycheck, but this amount you will be paid in the next year. But this employer must calculate these because this expense or payroll expense belongs to this year, even though you're going to get paid next year. So they say, for example, you working $15 an hour and this you work for 5 days, 40 hours, you have $600. So this $600 needs to be recorded in this year, say debit payroll expense for $600 and credit payroll liability of $600. Means what you are saying that we have an expense that belongs to this year, but we will be paying it at a later date. So if the last check dispensation date was December 26, so most likely you will paying around January 10 or 11 will be your next paycheck. So this money will be paid next year, but this expense belongs to this. And the same thing for the bonus plans, for example. In the bonus plan, some companies announce the bonus on say on December 15, and they say it will be paid on February 15, for example. So since you announce the plan today, it is your liability. So what you're going to say debit bonus, say $10,000, and credit bonus payable for $10,000 because you are not paying right now, but you have promised. So you are liable now that since you have made a promise that you will pay it on February 15th. Now this is warranties. All of the warranties, there will be a question. I mean, everything that we have discussed, there will be a question, but warranties would be a question too. So let me give you an example. You are purchasing a new laptop. You go to Best Buy and purchase a laptop, and the Best Buy people tell you, hey, do you want to buy an extended warranty? What is an extended warranty? All laptops, or majority, almost every single electronic device that you purchase comes with a 1-year warranty. In that 1 year, the company is responsible. If something happens to the product, they're either going to fix it or replace it for you. However, when you buy an extended warranty, that extended warranty, you have to pay for it. Say you pay $200 extended warranty for the next 3 years. So you are covered for the 3 years beyond that first year. So you have a free warranty for the first year, and then you purchase 3 years. So you're paying them $200. When you're paying that $200 in advance, you making the company responsible to take care of your product for the 3 years after the initial first year. So the companies has to estimate how much money the people are going to buy, and then how many products are going to be defected, and how many times they will have to either replace or fix the product. So understand in this way: suppose you purchase a laptop, and after 6 months that laptop is not working. You are calling a customer service or their technical support. They're trying to troubleshoot over the phone. They couldn't do it, and they ask you to drop the laptop at a certain location. Your laptop drop at a certain location, and they call you in 24 to 48 hours whether they can fix the laptop or not. So in the next 48 hours, you will find out whether you're going to get a new laptop, and of course that laptop you will get it for free because it's still under warranty, or they will fix it for you and give you back your laptop in 3 to 4 days. So when you are calling, somebody is there to take your call. So that is an extra expense a company has to pay because the product can be defective. And the same way, if they have a dealer or a technician they have retained in case if your computer couldn't be fixed over the phone, so they have to pay for that too. And if they have to replace they have to pay for it. So the companies has to estimate how much money they would have to pay in order to fix the defective laptop or replace it. So that is basically we call warranties. So many corporations guarantee their product against defects under warranty agreements. The time period of warranties varies by product and company. Usually it's 1 year for everyone. The matching principle requires business to record warranty expense in the same period that the company records the revenue related. So what they are saying that the company has not paid any expense towards your laptop, but they have to estimate. They have to make an intelligent guess. If I am selling, say, 100 laptop every month, how many laptop will be defective? Who's going to tell them? This comes from the engineering department. The engineering department is going to tell them, we believe 3 laptops can be defective. They could be more than 3 laptops. It could be less than 3 laptops. So every 100 laptops they're going to produce, approximately 3 laptops are either going to be needs to be fixed or replaced. So for example, they believe the cost for fixing or replacing these 3 laptops is $500 a piece. So they're going to say, okay, so we're going to estimate a warranty expense for $1,500. So they're going to say debit warranty expense for $1,500, and they're going to credit warranty liability for $1,500. So what they are saying that they have not put any money anywhere. Nobody. We are just creating this because we have what we call accrued accounting system. In an accrued accounting system, we have to, in order to have every transaction has to have a debit and has to have a credit. And when an actual expense comes, we're going to take that actual expense against this warranty liability. So this information will go to your income statement, and this information goes into your balance sheet. Okay, and when actually some transaction happen, so we pay the warranty expense, then we take that warranty expense against this $1,500. Okay. Now the most important thing is about in this liability is contingent. Contingent are based on some probability as from the past events, right? A contingent liability is a potential liability that depends on a future event. So all the liabilities we have discussed are based on past event. The contingent liability is a potential liability that depends on future event. For example, you go to Walmart and there was a water, but you couldn't see the water because there are no sign. You slip and you break your femur, your hip bone. And then once you broke, you have to go to the hospital and it cost you $50,000. You turn around and sue Walmart for your damages. Now Walmart received your letter. They're going to send this letter to their lawyer. The lawyer say, there is a 50% chance that you have to pay. Or they're going to say, oh, there is a 80% chance that Walmart has to pay $200,000 to you. Or there is a 20% chance. So it depends on three things. So remote is say less than 50%, reasonably possible is 50-50, and probable is greater than 50%. So if it is less than 50%, you ignore it, you do not talk about it. When it is a 50-50 chance, you disclose into notes to the financial statement. And when it's greater than 50%, you do disclose, and you also accrued this liability saying, oh, debit contingent liability for $200,000 and credit liability for $200,000, and this would be contingent liability expense for contingent expense or $200,000 that you have to make a payment, and then you credit contingent liability for $200,000. You just letting the reader know that it could possible. These could occur due to lawsuits, environmental cleanup costs, and credit guarantees. Okay, so how do you record it? If the likelihood of future events is probable, record the liability. Just I gave you an example during the debit and credit. Is event is probable, reasonable estimate can be made of the amount of obligation, and if it is not, then disclose in the notes. Ignore if it's remote or 20%. Okay, so this is our chapter number 11. Please make sure to watch the video that I have created where I solve a comprehensive problem for the chapter, and it will and also do not forget to watch the videos that is provided by the publisher as well. Again, thank you very much for watching this video. I hope to see you in the next video.